Welcome back to the show. It is mid-March 2026, and the data coming across my desk this morning is frankly counterintuitive. We're looking at a world economy that has been markedly resilient to trade shocks over the last year. Yet, we are facing a massive deceleration in trade growth for 2026. But the real headline for me today isn't just the GDP numbers, it's oil.
It's always oil, isn't it? But this time the context is different. We aren't just talking about supply and demand, we're talking about a hot war with Iran and the potential, or rather the reality, of maritime instability in some of the world's most sensitive straits.
Exactly. Let's look at the numbers first. The World Bank is estimating global growth averaged about 2.7% in 2025, which was actually an upgrade from previous projections. For 2026, they are forecasting a slight edge down to 2.6%. But here's the kicker. Despite the ongoing conflict in the Middle East, commodity prices are projected to decline by about 7% this year. Brent crude oil, which averaged $69 a barrel in 2025, is projected to drop to $60 in 2026.
That $60 figure seems like a fantasy when you consider the geopolitical risk premium we usually see. What is driving that downward pressure?
It's a combination of factors. First, we have subdued economic activity, particularly the slowing growth in China, which is expected to hit 4.4% this year. Then there's the payback from the massive front-loading in 2025. Firms were stockpiling goods and commodities like crazy ahead of the 2025 tariff hikes. Now those stockpiles are being drawn down and demand has cratered.
So essentially, the markets are more worried about a global demand slump than they are about the closure of the Strait or the Iran war narrative. That's a dangerous gamble. From a strategic perspective, the Iran war narrative shifted significantly after the June 2025 strikes. We've seen Iran's leadership transition toward Mojtaba Khamenei, which many analysts believe closes the path to a swift end to the war. If the Strait of Hormuz remains contested or experiences prolonged closures, the resilience you mentioned will be tested to its breaking point.
The data actually backs up your concern about the risks, even if the current price doesn't reflect it yet. While global financial conditions eased in late 2025 due to U.S. monetary policy easing, we are seeing a notable slowdown in demand for traded goods. If you add a supply-side shock from a strait closure to weakening demand, you get a classic stagflation setup.
We've already seen how tariffs can act as a supply shock, raising prices and lowering domestic output. And let's talk about the latest tariff whiplash. Just as the markets were adjusting to the IEEP tariffs, the U.S. Supreme Court struck them down in February, ruling the president exceeded his authority. That would have reduced the trade-weighted average U.S. tariff from 15.4% to 8.3%. But the administration immediately countered by announcing a new 10% global tariff, maintaining the tariffs are central to the agenda.
That uncertainty is the poison in the data. The OECD noted that while the global economy was resilient in the first half of 2025, the full effects of higher tariffs and policy uncertainty have yet to be felt. My concern is the lag effect. BIS models suggest when tariffs resemble an adverse supply shock, central banks face a difficult trade-off between stabilizing output and maintaining price stability.
If oil prices stay at $60 because of weak demand, but a strait closure suddenly forces them to $120, central banks are essentially trapped. If they look through the price spike to support output, they risk inflation expectations becoming unmoored. And we know from the 2025 BIS household survey that households perceive inflation is much worse than it actually is, and often overestimate losses in real wages.
That's a great point. Informed households, those who understand what central banks actually do, tend to have better anchored expectations. But knowledge of central banks remains limited, and many people now get their economic news primarily from social media, especially in emerging markets.
That creates a volatility loop. A geopolitical event, like a maritime disruption, spreads rapidly across social media and shifts household sentiment even if the underlying macro data hasn't changed. Let's outline two possible scenarios. Scenario 1, the resilience scenario. China's policy support offsets its property downturn. U.S. AI-related investment remains strong, and the global economy navigates the 2025 trade slowdown with a soft landing. In that case, oil stays near $60 as supply rebalances and demand remains modest.
Scenario 2, the geopolitical fracture. The Iran war intensifies. The new 10% global tariff triggers retaliation from the EU and China, and the strait becomes a persistent choke point. In that case, the $60 oil forecast becomes irrelevant. We would likely see a material loss of global output, and central banks might have to raise rates aggressively even as the economy shrinks.
And we shouldn't forget the fiscal side. Government issuance has driven the expansion of bond markets, and governments are now the largest borrowers globally. If we hit a recession, and Goldman Sachs still puts U.S. recession risk at 45%, the fiscal space to react will be much smaller than it was in 2020.
It's a roller coaster in the dark, as one conservative lobbyist recently described it. The shift from a world governed by stable rules to one of transactional, deal-by-deal policy makes long-term planning extremely difficult for businesses.
We're already seeing that in corporate earnings. While the Magnificent Seven tech companies drove markets higher in 2025, large retailers like Home Depot and Target are cutting forecasts due to consumer uncertainty.
So we have a world that is still growing on paper, but strategically fragmenting. The resilience we've seen may simply be the result of temporary factors like stockpiling and front-loading, which are now fading.
As we wrap up, the core question is simple. If the data says oil should be $60, but geopolitics says the straits are closed, which one wins?
History suggests the straits win in the short term, but macro fundamentals win in the long term. The real question is, how much damage happens in between? That brings us to today's question for the audience. In a global economy where resilience has been driven by temporary factors like stockpiling and front-loading, what poses the greater threat to your financial outlook? The return of 1930s-style trade barriers or a major energy supply disruption in a contested geopolitical strait?
We look forward to hearing your thoughts.
See you next time on The Macro Edge.